So family investment companies, I'm going to cover this. I call them FICs. That obviously stands for family investment companies. Why they're really useful is because depending on when you start, they can diminish IHT to 0. So normally it is, you have the dad and mum who have what we call freezer shares. Basically what we're doing is we're freezing their value, but we're still giving them all the rights for dividends and voting. That is so important, but the value of their shares is frozen. That's why this family investment company can be so, because then the IHT doesn't increase. What happens in UK property, typically for the last few hundred years? Every 10 years. Doubles every 10 years. That's been the historical trend. So what you're doing is you're freezing the value. Then there's another share class, right? So you can have quite a few shares on this. And what you do with those is you make them dividend only shares. And these can be gifted. You've got to be careful when you do these. Just make sure, because these can be gifted to family members, preferably over 18. And depending on how they're set, they don't trigger too much CGT, if any CGT, because of the value of the share. I'm talking at a high level because in order to do these, and I emphasize, you need an accountant, tax advisor switched on, a legal person, we use barristers, as well as a review of financing to do these. These are not self DIY tools. I'm just letting everyone know because I've had people talk about it that way and then they come and they're very upset because it didn't work. Because you need all of that to make sure it's all lined up because there's so many implications.